So when we meet clients to discuss inheritance tax advice, it's often alongside making their wills. And when we meet them to make their wills, we'll often advise them a number of strategies to reduce their inheritance tax. The first of which is to increase their day-to-day spending, whether that's holidays or nice cars, but clients often tend to find that very difficult. We tell clients to start making bigger gifts as soon as possible so that they can reduce their inheritance tax liability, and that falls out of their estate after 7 years. It's important that clients use their £3,000 annual allowance each tax year to reduce their tax burden. They can also put money into trusts, which we'll discuss a bit later, to help reduce their tax as well. We'd also then try and speak to an IFA to discuss things like insurance or inheritance tax investments, which is where an IFA comes in.
And I think that is where we would come in. So after discussion with yourself, Ed, a client would come to us, and we would be sort of more product specific led advice in terms of life insurance, investments into trust and other aspects as well. So that's where we would come in together.
Yeah.
Probably evident from the answers to the last question, Ed and myself do give different types of inheritance tax advice. So Ed's advice will primarily focus on the planning aspect of it, and while we're authorised by the FCA to handle the financial product solutions. So often what myself and Ed will do is sit down with a client on a roundtable discussion, often bringing in perhaps their accountant as well, particularly where business assets are involved, and have a really roundtable discussion to see what mitigation solutions best suit those clients' circumstances. Obviously, Ed, you're qualified from a legal perspective to handle the wills and trusts, which we can't do. And conversely, we're qualified to handle the financial product solution side of it. So we do work very closely together in conjunction.
So yes, it is possible to put everything into trust. And if you live for 7 years from doing so, it would be outside of your estate. But there are downsides to doing so. The biggest of which is that you're only allowed to put £325,000 into trust tax-free. Everything above that, you'd pay an immediate 20% charge. And you also lose the right to benefit from those assets. So you have to cut ties them completely. Having said that, trusts do have their place, but they tend to be very circumstance specific during your lifetime, and trusts tend to play a much bigger role when we come to look at your wills, and it's things like care home planning, when you've got second families to take care of, or protection for vulnerable beneficiaries, and that's where trusts really come into their own.
So yes, unfortunately, as with everything, there comes a cost. However, both solicitors and IFAs will offer a no obligation initial meeting to help you understand your current position and find out whether they can help you. Generally speaking, most professions offer a range of fee options. So it might be an hourly rate, it might be a fixed fee, or it might be a percentage based on the amount that you're looking at investing, perhaps, potentially. Any cost will be disclosed to you before you proceed with any advice. But it is important to remember the cost benefit analysis of what you're trying to achieve. So usually, in most cases, the amount of cost is dwarfed by the amount of inheritance tax that you can potentially save on your estate. So it is worth bearing all of these factors in mind.
So yes, there are a number of quick inheritance tax wins. There's the £3,000 annual allowance as mentioned above for each person, each tax year. And there's also the £325,000 you can pay into trust tax-free. Above and beyond that, you can pay £250 to other people, which is called a small gifts allowance, and you can give away your surplus income. So if your income vastly dwarfs your expenses, then you can give away that surplus income tax-free. Finally, if your children or grandchildren are getting married, then you can give them a gift on the occasion of that marriage. It's always worth remembering that.
Thanks for confirming those, Ed. It's probably worth mentioning as well that these allowances have been in force for decades and their values haven't changed. So as a percentage of overall growing estates, they may seem relatively small. And although they are quick wins, they may not make any significant impact. So it's always worth reminding people that the value of professional advice from somebody like yourself and somebody like me conducting a review together.